Okay, so very good evening to all of you. Now, today what we are going to share is about monetary policy. See, what we have done in the past, we have covered two chapters, that is money demand and money supply. So money demand, when we were discussing about money demand, what were the important factors? That money demand is for two components, isn't it? So we had shared what is the meaning of constant behavior of public and commercial banks. Okay, this I can see for the last term. Okay, Bhumika, I'll take your query later. You are talking about constant behavior of public and commercial banks. So we'll discuss that later. Right now, we are discussing about monetary policy. And with respect to the monetary policy, we have shared, see, monetary policy is what? It is about money, isn't it? So we have started with money demand. So who creates the money demand? We had shared households like us, we create money demand. What for we create money demand? We create for transaction and for store of value. So transaction demand is basically for which purpose? For consumption, and store of value is for creating wealth. So this is what households they demand money for. And what about corporate? They create money demand for? They create money demand for paying their credit obligations, and the other is about investments, isn't it? So this is what money demand is all about. And we had shared money demand with respect to different theories. We had shared quantity theory of money demand. Then we had shared about that money demand is created for uh, different asset portfolios. So this is how we had shared. I hope you are clear with that. Then we had shared money supply. So money supply is to meet the demand of money, isn't it? So who creates the supply for money? We had shared high powered money. High powered money is created by whom? By Reserve Bank of India. So which is also known as narrow money, and it is high powered money, which is also known as reserve money. Then the other component through which money supply is created by banks, we had shared no last class. So the banks create money. How they create? Through credit, through deposit multiplier. And high powered money is about money supply multiplier, which we had taken money multiplier by taking money supply in the numerator and monetary base at the denominator. So we had shared money supply multiplier, money multiplier, and we had shared the deposit multiplier also in the last class. Now, sometimes it happens that the money demand exceeds the money supply. Now, if money demand is more than money supply, what is going to happen? So it's a simple logic. When you go to buy a commodity in the market, suppose the prices of petrol prices going up. Why petrol prices goes up? Because the demand of petrol is increasing, but the supply of petrol is not increasing. That leads to increase in the price level, isn't it? So when the money demand increases more than the money supply, then what will happen? Prices in the economy will increase. That is one reason. So this is known as demand pull inflation. You might be knowing about that. The other factor which may lead to increase in the price level is that, like we see Russia and Ukraine crisis. Because of that, what's happening? There is a shortage of oil, there is shortage of wheat, isn't it? So because of that, the prices are increasing. So this is cost push inflation. So when it happens because of the increase in the cost of the production, the prices goes up. Now, when the prices are increasing, in that case, RBI is the body which has to ensure that the prices should remain stable. Why is it important for RBI to take care about prices should remain stable? So you think about yourself. When you see the prices going up, how do you start behaving? When you see that the price of a particular product is increasing, what we do normally when you see petrol prices are going up, what we do normally, we go for filling up the tank. No, that tomorrow the prices will increase. So we like to shell out more money. Let's fill the tank today only. So what is the human tendency when the prices goes up? We start buying more and more. When we start buying more and more, what is going to happen? The prices will further increase. And if the prices are going to increase, then in that case, the banks will go for increasing the interest rate and overall cost of borrowings will increase. So prices, if it increases, that's bad for the economy. If prices goes down to a very low level, that is also bad for the economy. Why? Why do you think that? Do you think that prices, if they are reducing, are substantially low, is it bad? Or if the prices are going down, it is always good. If the prices are going down. So, you know about Japan? Japan has a zero interest rate policy. Why? Because that country is passing through deflation. Deflation means the prices are too low. If the prices are too low, then what happens if the prices are too low? If you are a businessman or a corporate, if the prices are too low, will you produce that good? You will not produce, no, because the prices are low and that makes you to incur loss. So why should you produce? So you will not produce. So low prices are factor of disincentivizing producers to produce. Now, no investments in the economy, that means no production. No production means no jobs. No jobs means unemployment. Unemployment means further decrease in the income of the people, and decrease in the income of the people means further demand in the economy will decrease. So that's also bad, isn't it? So prices below, too low prices are bad, too high prices are bad. And that is why RBI act as a savior. How? Through monetary policy. So what is the role of RBI or the Reserve Bank of India or the central bank of any country? To take care about balancing prices so that the prices should not be too high, the prices should not be too low, and the economy should grow at a stable rate. Because if prices will increase, government debt obligations will also increase. Debt obligation increases means the country will run into debt. We have seen what has happened to Sri Lanka. So government borrowed and they could not repay their debt, and they incurred huge, they were in deep neck in debt, and people have to suffer because of that. So what I mean to say, that price level in the economy or the inflation in the economy should be moderate. It should not be too high, it should not be too low. And who has to take care of this? Ideally, it has to be taken care by Reserve Bank of India. And how Reserve Bank of India takes care of it? Through monetary policy. So that is the significance of monetary policy. Yes. So we are sharing today monetary policy. What is monetary policy? Why monetary policy is important? How RBI takes care about controlling money supply or money demand in the economy so that the prices should not shoot up, or the prices should not be low, or the liquidity in the economy should not be too high, or it should not be too low. So that's the role of monetary policy. Okay. So what is monetary policy is about? It takes care about supply of money. Supply of money should be managed, because if there is oversupply of the money, what is going to happen? Money supply increases means liquidity increases. Liquidity increases means people go for buying more and more. People buy more and more, but it's not visible. You can't see my screen. Okay, so shall I share it again? Can you see now? Is it visible now? Can you see now? Okay. So monetary policy basically is the management of money supply. So you can manage money through this. Monetary policy helps to control liquidity of the money in the economy. It helps to distribute the money in the right manner. So for example, poor people, they do not have enough money. It can help to reach to poor people. And if the government goes for giving guidelines to Reserve Bank of India. Reserve Bank of India give guidelines to commercial banks. See, you have to give loan to MSMEs at a low rate of interest. You have to give loan to farmers at a low rate of interest because they want to buy their machines, irrigation, and others. So government through RBI gives guidelines. This is what is about direct or the indirect way of taking care about liquidity in the market. So indirect way of liquidity is through banks. So RBI gives guidelines to banks, and banks, they take care about liquidity. Okay, so that is indirect way. Direct way is that RBI gives guideline to commercial banks. See, there are two components with the commercial bank. One is CRR, that is cash reserve ratio, and other is SLR, that is statutory liquidity ratio. So what happens in the case of cash reserve ratio is the banks, suppose let's say the bank is having 100 crores of deposits. Out of these 100 crore of deposit, if RBI says that CRR is 4%, so 4 crore will be kept with Reserve Bank of India. So that money is kept with the Reserve Bank of India, and we had shared, you remember, the money multiplier impact. If banks have less reserves, then in that case, what happens? Less reserves if the bank are having, that means if they keep 4 crore aside, and if suppose CRR increases to 6, then in that case 6 crores gone. So now the banks are having how much? 92 crores. If it is 4, then in that case banks are having 96 crore. So if they have 96 crore, then in that case they will be able to dispose, they will be able to give more loans, isn't it? So if the banks are able to give more loans, we have studied credit multiplier. So what's the impact of that? Then in that case, the money will multiply, and this will create more money supply in the economy. But if the CRR increases to 6%, then in that case, the banks are left with how much? Banks are left with only 94 crore. So 94 crore is definitely less than 96 crores. And this money is kept with Reserve Bank of India, so banks cannot use. So this is the direct way of controlling money supply in the economy. So what is the direct way? Through CRR. Other is through SLR. So what can be done through SLR? SLR is statutory liquidity ratio, where banks, what do? Banks have to, RBI gives guidelines, 22% of your deposits you have to keep in the form of statutory liquidity ratio. That means that 22% you are going to keep with yourself in a bank, but you cannot go for using it for lending. So you cannot give it to, you cannot go for loans. So suppose 22% is kept, so 4% gone for this, isn't it? 4% gone for CRR. That is, the bank is left with how much now? 96. Now out of 96, you further deduct 22. So that means how much the banks will be left with. So if it goes down, that means 22% plus 4. That is how much? 26%. 26% gone from the bank's books, which they cannot use for lending. So 26% means that is 430. So they are left with how much? 74 they are left with, no? So 74 they are left with, and only 74 crore they can go for lending. So what is SLR? SLR is the part of deposits of the banks, which the banks have to keep it with themselves. Where do they park that money? They park that money into two things. One is gold reserves. So they can invest in gold. They can invest in 74, yes, 74 crores. So 74 crore they are left with, and this 74 crore they can go for giving loans only. So 22 crores of the money the bank will keep not only in the form of cash, but they will go for keeping how? They'll go for buying gold, they'll buy foreign exchange reserves, they can go for government securities. So this money they invest. Banks can invest and they can get return through that, but they cannot go for lending, it can go for loans. So 74 crore left out of 100 crore if 22% is SLR and 4% is CRR. If SLR is going to increase, CRR is going to increase, this 74% will further go down and down. So this is how directly RBI controls liquidity in the market through commercial banks. Yes. So this is the direct way. Indirect way is through interest rates. Interest rates, when RBI goes for increasing the interest rate, then in that case, commercial banks will be having more expensive borrowings. Expensive borrowings means they'll lend you at a higher rate. So this is how it works. I hope you can see my screen. So money supply and liquidity of money. So what is the role of monetary policy? Monetary policy takes care about money supply through high-powered money and liquidity of money. That means money demand. Money demand is taken care through the monetary policy. So money demand can be controlled by Reserve Bank of India through monetary policy, which can bring stability in the economy. That should be clear to you all. I hope it is clear. Good, screen is visible. That was my concern. Okay, thank you, Sudhanshu. So what is the core of central bank? Central bank has to maintain economic stability. How to maintain economic stability? Through prices being more stable. More stable prices are, economy will be stable, because if prices increases, it creates a problem in the market. Your company's returns will decrease, profits will decrease, your dividends you will get will be less, income will reduce, investments will reduce. So it's very important that for economic stability, prices should be stable and the liquidity should be well within the control. That is taken care by Reserve Bank of India through monetary policy. So what is the main objective of monetary policy? Main objective of monetary policy is to promote economic stability. So they take care about economic stability and macroeconomic goals. That is the role of Reserve Bank of India through monetary policy. So country like India, what is the core goal of monetary policy in developing country like India? It is essential to take care about economic growth. I hope in prior chapters you have studied about GDP. So you know economic growth is very important. And GDP comprises of what? GDP comprises of production of different sectors. Primary sector, secondary sector, tertiary sector, isn't it? And the production depends on what? Agriculture. If farmers have to produce, and if seed prices goes up, then in that case, their cost of production will increase. Farmers will not be able to get good price of their wheat produced in the market and they lose. Since from wheat, atta bread is made, so atta bread price will increase. The packaging cost will increase and all the costs will increase. So economy will be on the downturn. So it is very important for RBI to maintain indirectly sustainable economic growth. Okay, it is also important for monetary policy to take care about that enough credit flow should be there. Because you saw during COVID what happened. During COVID, people were hesitant to spend. So RBI through banks took care about promoting credit. How to promote credit? By reducing interest rate. So it is also responsibility of RBI to ensure adequate flow of credit. Because if credit flow is not there, then economy will not grow. We have learned credit multiplier or the deposit multiplier, isn't it? So if enough money is not there in the market or people are not spending money, then in that case, production won't happen. So that is also RBI role to ensure adequate flow of credit. Okay, next is to take care about interest rates. Because if interest rates are too high, then in that case, investments in the economy will decrease. If interest rates are too low, then people will not go for putting money in the bank. So if interest rates are too low, we will not put money in the bank. We have shared, no? So if you will not put opportunity cost of keeping cash, we had shared. So if interest rates are too low, you will not keep money in the bank. You're not keeping money in the bank. Banks do not have enough money. If banks do not have enough money, how will they go for loans? So it is important that to sustain a moderate structure of interest rates so that investments should happen in the economy, and these investments will lead to what? More production, more employment, more income, more spending, more credit multiplier, and the economy will prosper. So that is very important to take care by RBI. So that is also one of the objectives of RBI. Then to ensure that government securities are also known as T-bills, treasury bills. What do you mean by government securities? Government securities are zero risk kind of investment option for people. Why zero risk? Because it is issued by whom? It is issued by government. And who is the custodian of government? So who takes care about government funds? Reserve Bank of India. So who issues government securities? Reserve Bank of India issues government securities. And who buy these government securities? These government securities can be purchased by us for investment purpose. These are also purchased by banks because they have to maintain SLR. So they invest in government securities. So government securities is one of the way through which RBI controls money supply in the economy. Okay, we'll share it later, but I hope broadly you understand that government securities are issued by whom? It is issued by Reserve Bank of India. Why? Because Reserve Bank of India is the custodian of government. So government park all its money with government wants money, so government will take it from Reserve Bank of India through government securities and bonds. Okay, so this is how it works. So and apart from that, what all RBI has to take care, RBI has to also ensure that rupee should not, so $1 equal to 81 today, it should not go to 85, 86. Why? Because if it goes to 85, 86, then in that case, if you import, that means for each dollar you have to pay 5 rupees extra. And if you are importing in billions, then you can understand how much additional money you have to pay. Suppose country has taken loan from other country and we have to pay in dollars. And if rupee $1 equal to 85 or 86, then in that case, for each dollar, India has to pay more rupees, forgo more rupee. So it is also important for Reserve Bank of India to maintain exchange rate stability. That means the rupee should not depreciate too much. Depreciate means it should not become uh, cheap in the market. It should not become very expensive in the market. So that is how. So it is also important for Reserve Bank of India to take care about foreign exchange. Foreign exchange should be, or the exchange rate in the economy should be stable. So that's also role of Reserve Bank of India. Okay, so these are the functions Reserve Bank of India has to ensure, and how it ensures through monetary policy to great extent. So role of RBI we have shared. What is the role of RBI? RBI has to take care about price stability, has to maintain employment. How RBI will take care about employment? See, employment is created by whom? By corporate. And what helps corporate to generate employment? If their goods and services are sold in the market. How their goods and services will be sold in the market? If consumers have money to spend. How consumers will have money to spend? If they get salary. So it's a complete circle, isn't it? So it is important that corporate should create jobs. And corporate to create jobs, what do they need? They need their cost of capital should be low. How cost of capital will be low? If banks can go for offering them loan at a low rate of interest. So the cost of borrowings will reduce. The cost of borrowing reduces means the cost of production will reduce. Cost of production reduces means they can sell goods at a low price. If they can sell goods at low price, then in that case, the sales will increase. Sales increases means revenue increases. Revenue increases means they'll gain profit in the long term. They gain profit means if you have brought those stocks, you will get higher dividends. At the same time, people in the organization will get salary. They'll get salary, their jobs will be secured, and this will lead to sustainable growth. So employment is also indirectly taken care by RBI through maintaining price stability. If prices are not stable, employment will be adversely affected. Economic prosperity. Country, Venezuela. Venezuela is the country where there was hyperinflation. So the prices increased by 1,000 times. So if you have to buy a loaf of bread also, you have to take money in bulk to buy one bread. Why? Because prices had gone to that level. So country's economic health, economic prosperity, how well-being of the people, Then happy people or sustainable economy is all dependent on what? Stable prices. If prices are not stable, countries' debt loan obligations will increase, corporate cost of capital will increase, people income will decrease, and this will lead to low level of economic growth, and this will lead to unhappy people, crime will increase, people will not be able to afford basic requirements in life. So that's the role of RBI. So RBI has to take care about price, indirectly employment, and long-term economic prosperity and welfare of the people. So short-term, what RBI has to ensure that prices should be stable. And to ensure stable prices, what uh, has been decided? It has been decided to go for inflation target. What is inflation target? Inflation target is that the limit has been fixed. So lower minimum price will be, inflation level will be 2% and maximum inflation will be 6% in the country on an average over the period of time. If inflation increases beyond 6%, if inflation goes below 2%, then in that case, it's a matter of concern because we know that if prices are too low, that is bad. If prices are too high, that is equally bad. So what RBI has done, RBI has decided that inflation will be within the target limit. What is the target limit? Target limit is minimum should be 2, maximum should be 6. So to maintain this inflation within the range, what RBI has to do? RBI has to use different tools. These tools can be directly through banks, or it can be through market. So we will be sharing what are the tools, different tools RBI can use to maintain inflation within the range. Okay, so RBI job is, what is RBI job? RBI job first and the foremost is price stability. Second, through price stability to maintain economic stability, to maintain employment in the economy, to ensure economic growth of the country, to ensure well-being and the welfare of the people in the country, and to take care about that there should not be too much disparity between rich and poor people in the country. So this is the role of RBI. So RBI is not only taking care about price, it is taking care about any number of other objectives, which are definitely not direct, but indirect in nature. Okay, so central bank takes care about what? Price stability, to keep inflation within control. The control limit is 2% minimum, maximum 6%. So central bank has to ensure that supply of money in the economy should be managed. That means the credit in the economy should be, liquidity in the economy should be well managed. How do they take care? Through buying and selling of what securities means? Government securities. We have shared. What do you mean by government securities? These are financial instruments which are issued by Reserve Bank of India on behalf of Government of India. These are zero risk because these are issued by, who's backing it? Government is backing it. That is why it is zero risk. Who goes for buying these securities? Normally banks, they buy these securities. Why do they buy these securities? They buy these securities because they have to maintain SLR. And SLR is the amount of money which the banks cannot go for using it for loans, but they can invest and can get returns. So where do banks, they go for investing? They invest in securities. So through securities, government securities, RBI can go for maintaining liquidity as per the need of that particular period of time. This is known as open market operations. What are open market operations? Where RBI goes for selling government securities or government bonds, or can go for buying government bonds. So when you buy something in the market, when you go for buying something in the market, what happens? You buy that product and you pay the price, isn't it? So you pay the price means the money goes from your hand to the one who is selling that. Same happens in the case of government securities. So if RBI wants to decrease money demand in the economy or liquidity in the economy, what RBI will do? RBI will start selling government securities and government bonds. So if RBI sells government securities and government bonds, what is going to happen? People will be buying government securities and government bonds. So if people buy, money gets absorbed from the market, and money gets absorbed means the money demand in the economy will decrease. So to absorb or to reduce money demand in the economy, what RBI will do? RBI will go for selling government securities and government bonds. So if they sell government securities and government bonds, that means people buy. People buy means money comes to RBI and people get government securities. So since the money supply reduces means money demand in the economy will reduce. So this is how RBI takes care about money supply and money demand to control price level through government securities and government bonds. This is known as open market operations. What is open market operations? Buying and selling of government bonds and securities by Reserve Bank of India so that it can control money supply in the economy, which helps to reduce liquidity in the market. Since the liquidity reduces, money demand in the economy reduces and prices become more stable. Any questions? If you have, you can ask. Any questions? So it is clear to all of you what's the role of RBI and what RBI takes care about. Okay, so RBI not only takes care about price stability, ensures price stability, it also ensures economic stability. It ensures long-term employment, economic growth. It also ensures that the country should not lead to debt. At the same time, it ensures that corporates should not suffer. Consumers should buy products. So this is the role of RBI on a broader front. Okay. You might have read in the newspaper many times that, good. So many times you might have read in the newspaper that there is the policies, expansionary policy, monetary policy RBI is adopting, or a contractionary monetary policy RBI is adopting, or the rate has increased in the market. So what is exactly expansionary and contractionary monetary policy? Expansionary itself means expansion. Expansion means you go for easy money. How can RBI ensures easy money? By decreasing the interest rate. So if RBI decreases interest rates, that means we have read money multiplier, you remember? We have read credit multiplier. So what's going to happen? If RBI decreases the rate, then in that case, I'll talk about repo rate later, but you simply understand if RBI decreases the interest rates, what's going to happen if RBI decreases the interest rate? RBI decreases the interest rates, that means banks will become more rich. Banks becomes more rich, that means they will be lending or they will be giving loans at a low rate of interest. So who will buy these loans? We will buy loan. Why will we buy? As a consumer, we'll buy loan. We'll buy car, we'll buy mobile, we'll buy fridge, we'll buy so many other things, scooter and so on. So consumers can buy because the interest rate is low. So consumers are buying. Since consumers are buying, corporate will produce, isn't it? Other factor can be corporate will also be buying loans. Why corporates will taking loans? Because now the interest rate is low. Their cost of borrowing goes down. Their cost of borrowing goes down means their cost of production goes down, and that becomes more profitable for them. So they'll also take loan. So when will RBI goes for decreasing the interest rates? RBI will decrease interest rates when, like during COVID. What happened during COVID? RBI adopted expansionary monetary policy. Why RBI adopted expansionary monetary policy during COVID? Because we had shared that, you remember we had shared that when we feel that risk is there, money demand, we had shared, when you feel that risk is there, what do? You spend less. Why do you spend less? Because I may not have job tomorrow, or the market will be bad, so prices will further increase. I should save money today because the risk is higher. So in that case, people were not spending. Since people were not spending, so the consumption demand decreased. Corporate, they started losing. Their inventories were piled up. So they incurred loss. Since they incurred loss, they had taken loan from the bank. They could not pay back to the bank. So bank's balance sheet also got affected. So that is why RBI had to go for expansionary monetary policy, means to keep interest rate or the policy rate low. And that could motivate people, consumers and consumers to buy, corporate to invest. So that was the idea. Okay, so when RBI adopts expansionary monetary policy, expansionary monetary policy is adopted when sentiments are low, when economy is on the downturn, when corporate are hesitant to invest, when economy is not doing so well, then the central bank goes for expansionary monetary policy. Okay, expansionary monetary policy means to make easy money, make people get easy money. How to get easy money? By keeping interest rates low. Vice versa will be true. What is contractionary monetary policy? Contraction means to absorb the money from the market. How to absorb the money from the market? RBI will go for increasing the interest rates. If it increases interest rates, then in that case, banks will be having less money to go for giving loans. So banks will be going for high interest rates. Banks will be lending at a high interest rates. Corporate cost of borrowings will increase. We, the consumers, will think, oh God, it has become so expensive to take loan. We should not take loan. So we will not take loan. Corporate will not invest because their cost of borrowings will increase. So overall, what's going to happen? This is how the money gets absorbed from the market. How? By keeping interest rates high. So that is a contractionary monetary policy. So when will RBI or any central bank of any country will adopt contractionary monetary policy? When they see that inflation is increasing. If inflation is increasing, and to control that inflation, what RBI has to do? RBI has to go for absorbing the money. That means to decrease the money demand. How to decrease money demand? By increasing interest rates. If interest rate increases, then we had shared this prior that if interest rate increases, what happens? You want to spend more? No. Why? Because interest rate increases, then in that case, you want to keep less cash. You want to keep less cash and you want to deposit more. Why you deposit more? Because prior you were getting deposit interest rate of 5%. Now you're getting at 7%. So what will you do? You'll keep more money in the bank. So you keep more money in the bank. That means you have less money to spend. So you spend less, you keep more money in the bank. And this is how contractionary monetary policy is adopted by any central bank of any country at the time when inflation is high, when money demand is too high. So people are spending, and to control that inflation, RBI or any central bank goes for contractionary monetary policy. Yes. I'll take, Varsha, your question in the end. Please do remind me this regarding rupee value, okay, with respect to dollar. We'll take it later. What is unconventional monetary policy? Unconventional monetary policy is something which is not regular. So unconventional monetary policy is to go out of the way. Out of the way means like the way US adopted during 2008 crisis. 2008 crisis, what happened? Lehman Brothers collapsed. US economy was on the downturn. Sentiments were very low. And market had crashed. So all those factors made the Fed Bank in US to adopt unconventional monetary policy. Not only short-term, but long-term also measures were taken. And interest rate was almost to zero level. So zero level means you take money, please you take money and go for spending. and go for investing. But still people were not taking. So unconventional monetary policy is something out of the way you do to go for making people or economy back on track, because economy may be at such a stage where people have lost all hopes and nobody wants to go for spending. Corporate do not want to invest to that extent. So same thing happened during COVID. So government had relaxed all norms. Banks had were told that you cannot go for taking loan EMI from the people, extend the EMI terms and other things, extend the loan terms, simplify or liberalize the loan terms. So these were guidelines given by RBI to commercial banks on behalf of Government of India, because country was passing through crisis. So in the case of crisis, unconventional monetary policy is adopted by the central bank of that country. Okay, so we have shared three kind of monetary policy. One is expansionary. Expansionary happens when economy is on the downturn. How expansionary and unconventional monetary policy is different? Expansionary monetary policy is short term, which is for the specific purpose. But unconventional monetary policy can be something drastic change has happened. And to overcome that, they have to go for some unconventional way, out of the way, to accommodate the economy. So that is known as unconventional monetary policy. Two classic examples are global financial crisis, which happened in 2008, was at the peak rather. Second, COVID-19, which countries all across the world have suffered. And that time, the government, the Reserve Bank of India had gone for keeping uh, easy money available to people, injecting money in the economy, creating liquidity in the market, easing flow of credit in the market, so that people should go for spending. Corporate should go for investing so that economy can be back on track. Okay, Ritika is saying during inflation, increase in interest rates during inflation. See, Ritika, we had shared in the past, if you remember, theories of money demand. So what people do in the case of, what will you do when the inflation is increasing? If inflation is increasing, then in that case, why inflation increases? Increases, I've shared in the beginning of the session, because of two reasons. One, it can increase because of we start creating more money demand. We create more money demand means we want to buy more and more. We want to buy more and more means the supply is not going to increase at the same pace and the demand increases, so prices will shoot up. That is one reason. So that is demand pull inflation. Demand pull inflation is because people money demand increases. That is demand pull inflation. But money supply is not increasing at the same pace. So since this kind of inflation, where the money demand increases, it's very important to control inflation. How to control inflation? By going for increasing interest rate. If you increase interest rate, people go for putting more money in the bank. People go for investing more. You invest more, banks get money. Banks get money. That means they will be able to lend to corporate. So inflation, in the case of inflation, it's very, very important for RBI, first and the foremost, to control inflation. Because if inflation goes up, we have shared what is going to happen. First and the foremost, to control inflation. And to control inflation is through money demand factor. And to control money demand, interest rates have to be increased. There's no other option. That is why short-term interest rate increases, because money demand has to be controlled. If money demand will not be controlled, inflation will be out of reach for RBI to control in that case. Okay, so I hope it is clear. Ritika, I hope it is clear to you. So what RBI can do, RBI can go for disciplined approach. Disciplined approach means adopting some measures where in case of shocks, contingencies, I hope आप समझते हैं contingencies about some unforeseen thing. Okay, so some unforeseen circumstances may happen, and in that case, the Reserve Bank of India or the central bank of the country has to go for adopting some measures. Some buffer stock has to be created by Reserve Bank of India so that the country should not suffer. So that is known as macroprudential norms. Okay, macroprudential norms is disciplined RBI or the monetary policy approach. Very disciplined because they cannot afford in bad conditions to take risk, because RBI or the central bank of the country has to also ensure how banks are doing. If RBI will not ensure it, then in that case, the financial system of the country may collapse. So it's very, very important that RBI also takes care about prudential policy norms. Prudential policy norms are disciplined approach. If banks are not following the due diligence, then in that case, RBI can give guidelines to them. If RBI thinks that banks are exposed to high risk, then RBI can tell banks, guidelines to banks, see here you are exposed to high risk, do not lend to these sectors. So this is how RBI can give guidelines to commercial banks so that the financial system remains intact and country should not suffer at the cost of over leverage. Okay, so this is what is the macroprudential policy norms frameworks. So now you know about that RBI will take care about inflation. But the point is that if RBI goes for increasing interest rates, is it going to actually help to control inflation in the economy? Or there's something called transmission effect. Transmission effect is from RBI to commercial banks, from commercial banks to corporate, from corporate to consumers, and to market, to capital market, and to property prices, to exchange rate, and to human mind, how we start behaving. So these are different channels through which monetary policy transmits and makes impact on the economy. Idea of RBI is always from commercial banks to consumers and corporate. But there are other factors also which may make impact in terms of monetary policy may be effective in that case, monetary policy may become ineffective in that case. So there are different channels through which monetary policy transmits. So these are known as monetary policy transmission impact. This can happen through interest rate channel. So the first and the foremost is interest rate channel. Second is exchange rate channel. Exchange rate basically US dollar and INR exchange rate. Then quantum channel. Quantum channel means balance sheet of corporate and money supply in the economy, even balance sheet of banks. So quantum channel through which money supply in the economy and the credit may change. Asset price. Asset prices means asset in terms of your you have invested in capital market, so that is about equity, or it can be in terms of you have purchased house or real estate, you have invested in real estate, so real estate prices. So the impact of monetary policy can also be on capital market, it can also be on real estate. The last is expectations channel. Expectations channels are how consumers, like people like us, start thinking when we see that interest rates are continuously increasing over the period of time, or how we consumers start spending when we see that interest rates are continuously decreasing over the period of time. How do you start thinking about that? What will be the next move of RBI? Will they go for increasing interest rate? Since in the past they have decreased the interest rate, they will not increase the interest rate. This is how we perceive. Or when the interest rate keeps on increasing, you perceive, oh God, how long it is going to increase. And if it is going to increase, then I should also plan according to that. For sure, RBI will further increase the interest rate. So this is expectation channel. Expectation channel means how human mind starts thinking about, how consumers and how corporates start thinking. So these are different channels through which it is monetary policy is transmitted. Okay. So we'll share one by one. That is, first is interest rate channel. What is interest rate channel? See, Keynes, you remember Keynes? Keynes is the father of macroeconomics. He introduced what? He said that demand is the most important component. And for demand, he said what? That RBI core role is to control money demand. So if there is surplus money demand in the economy, then RBI should, or the central bank should go for contractionary monetary policy. We have shared how to go for contractionary monetary policy, increase the interest rate. So RBI will increase interest rates. If RBI increases interest rates, then cost of capital of the corporate will increase. Their cost of borrowings will increase. The cost of borrowings will increase means they will be discouraged to invest, no? So investments in the economy will decrease because corporate will not go for capital expenditure. So expenditures of corporate will decrease. That means households, at the same time, household cost of borrowings will increase. We have shared this. So you want to buy a house, you want to buy a car, you want to buy a bike, you want to buy your mobile, then in that case, your cost of borrowings increases because the interest rate goes up. You postpone your buying, no? You postpone means you do not buy. So aggregate demand in the economy will decrease. Corporate are not investing. Consumers are not buying. So overall demand in the economy will decrease. Overall demand decreases means output will decrease. Output decreases means, obviously, output decreases means employment in the economy will decrease. So this is the impact of contractionary monetary policy induced through increase in interest rate. And obviously, opposite, we have shared expansionary monetary policy. So what is going to happen in the expansionary monetary policy? RBI will decrease interest rates, easy money for corporate, easy money for people like us will buy more because easy money, low rate of interest. Corporate will be able to take more loans because their cost of borrowings will decrease. Consumers are buying, corporate are investing, goods will be produced. Goods produced means employment will increase. Employment increases means economy will prosper. That's the impact of expansionary monetary policy. Okay, so that is how interest rate gets transmitted. Monetary policy gets transmitted through interest rates. Monetary policy also makes impact on exchange rate. Exchange rate is dollar INR. So I'm coming to Varsha's question. Varsha had asked about why rupee values still go down compared to American dollar when American economy have problem and Indian economy comparatively in better position. See, Varsha, with respect to your question, since this we are talking about exchange rate, so first you understand this exchange rate, and then I hope you will get it. Otherwise, I'll share it with you. So what's happening today? World economies are squeezing, boundaries are squeezing. That means what? You can buy goods online today. Sitting here, you can buy Chinese products online. You can make payments online. Anywhere in the world, you can buy products. So what's happening? That transaction has become very easy from international market. And that is why exchange rate has become more volatile. Why volatile? Because you can buy easily, you can invest easily, you can withdraw easily. So that is why what's happening? The exchange rate has become highly volatile. And if rupee dollar rate becomes highly volatile, समझते हैं ना? The rate of change at which it is changes, it goes up and down. So if it goes frequently up or it goes down at a very short span of time, it goes down, that's a matter of concern. So in that case, what is the role of RBI? RBI role is that dollar INR exchange rate should be maintained. It should not become highly unpredictable. If it will become highly unpredictable, then in that case, what's going to happen? It will be, economy will be at stake, no? Because if the exchange rate is highly volatile, so who will invest in your country? They'll believe foreign players will not invest. They'll think that dollar may become any time high or low, and we will be exposed to risk. So why should we invest in a country which is highly risky or unpredictable. So it's very important for RBI to maintain exchange rate stability. And maintaining stability of exchange rate, what is important? That dollar outflow and dollar inflow in the economy should be managed very well. Because see what happens if RBI goes for increasing interest rates in India and interest rate in US is less. So what is going to happen? What will happen in that case? If interest rates are higher, so corporate who want to invest in India, so they will be investing in India because they will be getting higher interest rates. But at the same time, the domestic players who want to buy, they will not be able to buy. So that's the trickle down impact of interest rates on foreign exchange market. So what is going to happen? The changes in the monetary policy causes difference between domestic and foreign interest rates. So I don't know how many of you know about this or not, that when US government increases its interest rates, then in that case, you might have seen that India's stock market goes down. Why it has a negative impact on India's stock market when US interest rates increases? Because those foreign portfolio investors, those who had invested in India, when US interest rate goes up, they pull out money from India. They take out dollars from India for stock market and they invest back in their home country because there they are getting now high interest rate as compared to India. So what will happen? Dollar will start outflowing from India. If dollar starts outflowing from the country, then in that case, rupee will become weaker and weaker and dollar will become more expensive. So this is how the change in the monetary policy makes impact on the exchange rate. Is it clear? Credit channel. What is credit channel? If you can recap, we had shared when we were talking about money supply, we had shared that two ways money supply is created. One is created high-powered money. How high-powered money is created? High-powered money is created by Reserve Bank of India. The second is credit money. Credit money is created by whom? Credit through credit channels. What is the credit channel? Credit channel is from RBI to banks, from banks to corporate and household. So one is a bank lending channel. What is bank lending channel? We have shared interest rate channel. What happens? What exactly is credit? See, what exactly is credit? Credit is basically you are taking money. You are taking money. That means bank is creating assets, isn't it? Why? Because you are taking loan from the bank. You're taking loan from the bank. You will pay interest to the bank, plus you will pay the principal amount also. So since you pay interest on the loan amount, plus you pay the principal amount, that is the loan amount to the bank, that is how banks become more rich. Banks become more rich. That means banks can go for lending more. But if RBI goes for increasing interest rates, credit availability of firms and households will become difficult. So that means the overall credit, so the investments in the economy will decrease, output decreases, and unemployment increases. This we have shared. What is the other factor? It also affects balance sheet of corporate. How it affects the balance sheet of corporate? Now, corporate may have some credit obligations to pay to someone, and suppose interest rate goes up, then in that case, if the corporate has to take loan to further go for paying its loans, it will be very expensive. So one, corporate books will be adversely affected. How it gets affected? One, the cost of credit goes up. Secondly, corporate, which they were getting revenue through those, that will also get affected. So one, their debt obligation remains intact. Corporate debt obligation remains intact, but the revenue decreases. So it will have a adverse impact on their balance sheet. Now the balance sheet gets impacted. That means the corporate will be defaulting. If the corporate will default, will not pay back to the bank, banks will further suffer. So that's the impact. So interest rate not only affects the money supply in the economy, it also affects exchange rate. It affects corporate balance sheet. It affects, it leads to higher unemployment. It leads to decrease in output. It decreases investment in the economy. And the long-term impact is that maybe corporate become more, uh, get deeper into debt, and they cannot overcome that debt obligations because they cannot pay their loan amount, no? If interest rate increases, that means, uh, I don't know how many of you are aware about. So if anybody has taken education loan, so when you take education loan, what happens? Bank says that you take education loan at a floating rate of interest. Floating rate of interest means, that means if the interest rate by RBI will increase during the monetary policy, bank will charge higher interest rate from you. If RBI will go for decreasing the interest rate, banks will charge lower interest rate from you. So your loan cost goes up and down based on interest rates decided by RBI. Same happens with corporate also. Okay, so the corporate books also gets affected. So there is balance sheet channel also, which is reflected in corporate books, and there's impact on firms and household credit demand also. So that is the two channel impact, basically through interest rate which happens, and this is credit channel. Then what is the impact on you buy house? If interest rate goes up, will you buy a house? You will not buy a house. If you will not buy a house, then in that case, will real estate developers like Answers and Unitex will make more houses if they know repeatedly the interest rates are increasing? So they will not make more houses, no? Why will they not make more houses? Because in that case, they will invest in those houses, but people will not buy. People will not buy means their money gets stuck. So it has impact on real estate also. It has impact on your equity market also. So suppose you have taken stocks, certain shares you have purchased of, let's say, um, automobile segment. Okay, so you have purchased Maruti shares. So if interest rate goes up, so Maruti's profit margin will go down. Maruti's profit margin goes down. That means you might have purchased a Maruti share at 3,000 rupees, and now since inflation has gone up, Maruti is losing. So the share price has gone down to, let's say, 1,800. So from 3,000, it has gone down to 1,800. So what will happen? Your wealth will decrease, isn't it? So it makes impact on financial health of the household also. So they will also lose. They will lose means certain people, they run their family only based on investments in the market. They will be out of the job. They will be out of the job, or they'll incur loss. They'll incur loss means their family will be suffering in terms of consumption. So financial health of household gets affected. It may make impact on consumption. It affects output. It affects employment. So that's the impact on standard assets price channel. And if you look at these last two statements, what it says about the manner in which these different channels, that is credit channel, exchange rate channel, balance sheet channel, standard assets channel, how it makes impact depends on two factors. What are the two important components? How your economy is doing. Now, Varsha was asking about that Indian rupee is depreciating, but still Indians are happy. Why Indians are happy? Because our economy is prospering. As long as your economy is growing, you can afford to go for paying at a higher rate, isn't it? So how your economy, at what stage your economy is. So today, World Bank, IMF, everybody is saying that India is the bright spot. India is doing well. And that is why, despite inflation, despite rupee depreciating, still we are not so worried about things. Why? Because we know our economy is prospering, our economy is doing well. So all is well. And when you believe all is well, then in that case, you may not behave in the same manner what we have shared about different channels. So monetary transmission impact can be different when your economy is doing well. You may still go for buying. You may still go for investing. Corporate may still go for investing. Why? Because they know economy is growing. Economy is growing means people will get job, people will get job, people will spend, people will spend, people will buy, and our goods will be sold. So stage of the development of the economy makes very much plays very important role in terms of the impact of different channels, monetary transmission impact. If your country is not doing well, then in that case, these channels will have monetary transmission impact will be huge. If your country is doing well, then the monetary transmission impact may not be so significant. Yes. What are the other factors? Other factor is how your banks are, how the financial health of the country is, how financial system is. If your banks are doing well, you believe that your money is safe in the bank, you know that you may not lose your money, then in that case, you will be highly optimistic, no? But if you believe that country's financial system is not good, banks may default. Banks may default means I'll lose my money. I'll lose my money means you start withdrawing money. You start withdrawing money means banks become poor. Banks become poor means they will not be able to lend and the economy will suffer. So very, very important for these channels or the monetary policy impact is based on two factors: how your economy is growing or what is the potential of your economy, at the same time how the financial health of the country is. If the financial health of the country also decides about that, yes, we are doing well, so let's go for. If your banks are doing well, then in that case you believe yes, it's worth spending money, isn't it? So monetary policy plays very important. Monetary policy transmission effect depends on how your economy is doing, how financial health of the country is. I'm sorry. So how RBI goes for implementing monetary policy? It implements monetary policy at three levels. One is that uh, through banks. One is through the banks. Banks means I don't know we have shared in the past or not. Call rate and term money. Term money and call money. Call money is money which is interbank transactions. So suppose economy is doing well and people go for more credit demand. People go for more credit demand. So people will take more loans. People will take more loans means banks should have more money to go for lending. If bank is running short of money and people are demanding more loans, so what bank will do? Bank has to borrow. Why bank has to borrow? Because their customers, they want more money if the bank is not having enough money. So what bank will do? Suppose HDFC Bank has today high credit demand, but it is running short of funds today. So what HDFC will do? HDFC Bank will ask ICICI Bank, see, I need 100 crores today, and you tell me at what rate you can give me. So this is known as call rate. So ICICI Bank will tell the call rate, that is the rate at which ICICI Bank will lend money to HDFC Bank for a day. This is known as call rate for a day. This is known as interbank rate. Interbank rate. Okay. So RBI can control this interbank rate. How RBI can control interbank rate? Through controlling interest rates. If RBI goes for controlling short-term money market interest rates, then in that case, they can also control call rate. Because if short-term money market interest rate is low, then in that case, banks can borrow from the market at a low rate of interest. And obviously, the call rate will be low in that case. But if there is difficulty if there is credit, if there's lack of credit in the market, if there's lack of money in the market because of the high interest rates, then the call rate will go up. Call rate goes up means commercial banks borrowing cost goes up. Commercial banks borrowing cost goes up means their lending costs they will be lending at a high rate. So buying loans will become more expensive in that case. Okay, so that is one way. So you understand what is weighted average call rate? Weighted average call rate is on an average at what rate interbank borrowings are happening for a day. For a day. That is call rate. Okay, so if you calculate for a week or a month, fortnight basis, that on an average, what rate, call rate banks were borrowing, that is known as weighted average call rate. Okay, so this is one way. And how RBI will control through short-term money market. So short-term money market means for a day or 5 days or 7 days like this, interest rates to be taken care. And this will definitely make impact on call rate. That is one. So operating targets, short-term. Intermediate targets. What are intermediate targets? Intermediate targets are short-term as well long-term. That is taken care through repo rates and other rates. So which ensures that the stability of the economy, growth in the economy. So that is known as intermediate target. Intermediate targets are over the span of time, what you want to achieve over a successive period of time, 5 months, 7 months, 8 months, like this. So that is about intermediate targets. And intermediate target display about what RBI is looking for. RBI is looking for growth. RBI is looking for stability in the economy. That is intermediate targets. Okay. And the third component is through day-to-day implementation of monetary policy, which RBI can take care about. So RBI through day-to-day monetary policy ensures liquidity of commercial banks and the Reserve Bank capacity to take care about liquidity of commercial banks. So these are the three implementation routes through which RBI implements monetary policy. So what are the monetary policy instruments? Monetary policy instruments are cash reserve ratio, CRR, that and the liquidity reserve ratios, whatever is prescribed by RBI over the period of time to maintain enough liquidity with the banks, or maybe to curtail or to absorb liquidity from the market, or to control inflation respectively. Okay, so that is about one way. Second, so these are direct instruments we have already shared. RBI can tell CRR to commercial banks, CRR can be increased, SLR can be increased. So we have shared no 74 crore, it can go to 76 crore, and that is a direct way. That is direct instrument to control a monetary instrument used by RBI. That is direct instrument. Second is direct credit. That is telling banks, you lend at subsidized rate to students for education loan. You lend at subsidized rates to MSMEs. Those who are small manufacturers, give them loan at a low rate of interest. If somebody is buying BMW and taking loan, give them at a high rate. Loans to be given at a high rate. If somebody is buying a house, bigger house, then go for lending them at a high rate. So this is how RBI can give guidelines to commercial banks, which sector-wise or the segment-wise that you go for fixing interest rate on this. So normally RBI goes for giving guidelines to commercial banks, priority sector lending, farmers, MSMEs, education loans, girl child loan. So these are all subsidized, lower rate. So this is how they can control the money supply and monetary policy tool used by RBI. So these are direct ways through CRR, through giving directions for whom to lend, whom not to lend, giving guide, fixing. LIBOR and MIBOR are different. LIBOR and MIBOR, Manoj, is about London Interbank Offer Rate. We are talking about call rate within India. Within India, MIBOR is Mumbai Interbank Offer Rate, means it's the rate offered by between the interbanks, but it is about it can be 1 day or 2 day. We are talking call rate. There are different terms which are used. MIBOR is the rate which is used for all rates decided between the banks. That is MIBOR. London Interbank Offer Rate is the rate which is helping for all the interest rates across the globe. That is how. But weighted average call rate is the rate which is offered between two banks for a day. It can vary depending upon how the credit demand is in the market. That is how it is decided about. Okay, so MIBOR and LIBOR is very extensive. Uh, Call rate is for a day. It varies at a pace depending upon how the market is, how sentiments are. We have shared channels of monetary transmission, and you know about credit demand in the market. So that's the factor. Okay. So indirect instruments mainly consist of repos. Repo rate is that how the we'll share what is repo rate. That is known as repurchase offer rate. So we'll share that. Open market operations, buying and selling of securities, standing facilities, which banks can avail from RBI in the case of running short of funds. Market-based discount window. Uh, Banks can get loans from RBI by certain discounting at the discount rate. So this is how there are different ways through which they can control liquidity in the market. So what is repo rate? Repo rate, what exactly is repo rate? Repo rate is the repurchase offer rate. Repurchase offer rate is also sometimes called it as a two-leg process. Why? Because there is a government security attached to it. So interest rates at which Reserve Bank provides liquidity or can absorb liquidity is the core of repo rate. Repo rate is government securities, is backed by government security. So suppose let's say that, and this is the basic rate. This is the basic rate for all rates to be decided based on. Okay. So repo rate, how it works, it is the collateral here is government security. So suppose commercial banks, they need money. So what they'll do, they'll go to RBI. They'll say that, see, RBI, we want loan. So RBI will say, okay, fine. You give your government securities and take money from us. So you will take money from Reserve Bank of India and as a banker and will keep your government securities with Reserve Bank of India with the condition that after a specific period of time, you will repurchase those government securities from Reserve Bank of India at a pre-specified rate. So the rate is pre-specified and it is you go for taking from RBI with the condition that you'll take back your government securities. So it is always a two-leg process. That is repo rate. And that is why repo rate is always higher than the reverse repo rate. And repo rate is also known as policy rate. Repo rate also creates liquidity, is responsible for liquidity in the market. So can demonetization? No. Manoj, demonetization is not unconventional monetary policy. Demonetization was done by government. Demonetization was not done by Reserve Bank of India with a discretionary option of Reserve Bank of India. It was compelled by Government of India, and that is why it was introduced. So we cannot say demonetization is unconventional monetary policy. Monetary policy is always with the consensus of Reserve Bank of India. That was a government take, demonetization, not Reserve Bank of India. Okay, anyways, so liquidity adjustment facility will share at length as we'll proceed. Standing deposit facility is something where, please do understand that you please connect prior chapters which we have studied. Money demand means credit demand. Money supply means banks, they create money through credit multiplier or through deposit multiplier. And So basically, higher the credit demand, higher the money which banks have to create, isn't it? Credit multiplier should be higher. And for that, banks should be having more money. So in that case, banks we have shared, they can go for call rate or they can borrow from Reserve Bank of India, where they do not go borrowing through government securities. They borrow through uncollateralized deposit. That means they do not keep collateral as government securities, and they take money from Reserve Bank of India. So this money which they take it from Reserve Bank of India, when they're running short of funds, is known as standing deposit facility. And this standing deposit facility helps to manage liquidity. That's the idea of standing deposit. So when the banks, they are in need of money, they can take it from Reserve Bank of India without any collateral. When they go for not through collateral, obviously the risk is higher. So then in that case, standing deposit facility rate will be higher with respect to the policy rate. Okay, so standing deposit facility is the facility which gives RBI, which operates in the case when banks are having more money. Banks having more money, so what do? They go for depositing it overnight with Reserve Bank of India, and since they deposit that money, so Reserve Bank of India will offer them 20 over and above repo rate. Are you getting me? So what is the difference between buying from the bank, buying from Reserve Bank of India, or depositing money with Reserve Bank of India? One, banks deposit money with Reserve Bank of India by through repo rate. So the collateral is there, is government security. Other is that banks can deposit money with Reserve Bank of India without any collateral. When they go for depositing without any collateral, they get the benefit of interest rate, which is higher than which is lower than the repo rate, because you are not going for any collateral, no. So they get returns on that deposit, which they keep it at they get at a less than the repo rate. So standing deposit facility is the facility which is an option with commercial banks to deposit their money with Reserve Bank of India without any collateral for a day, and where Reserve Bank of India will give interest to the bank, but it will be less than 25 basis points less than the repo rate. So banks, what they get is less than the repo rate. Okay, so this is the introduction of standing deposit facility offered by Reserve Bank of India to commercial banks to park their money with Reserve Bank of India and get interest on that without any collateralized. Bank rate, what is bank rate? Bank rate is the rate which is not relevant in today's context, because the bank rate is only given in alliance with the marginal standing facility. Okay, marginal standing facility will share what is marginal standing facility rate. But before that, CRR is clear to you. I simply want to share with you people what is NDTL. NDTL is net demand time liabilities. Net demand and time liabilities are demand liabilities we had shared in the past also. Checkable deposits are demand liabilities. Time liabilities are fixed deposits. These are liabilities for the bank. Reason being, you have deposited your money and the bank is supposed to pay you interest on that. So that is liability for the bank. And that is why it is net demand and time liabilities, is that how much is the total difference between the loan taken and the amount banks deposits and the liabilities banks are having. So that is the total net demand and time liabilities banks have, which is based on that cash reserve ratio is decided. So if net demand time liabilities at the bank is 100 crore, 4% is CRR. So if bank is having more, if another bank is having 200 crore, then also CRR will be 4%. So rich and rich the bank is, respectively, more and more money the bank has to keep with Reserve Bank of India. So that percentage is decided by Reserve Bank of India. But how much money to be kept aside in absolute terms will be based on how much net demand and time liabilities the bank is having. Okay. So what is reverse repo rate? Reverse repo rate is that when RBI borrows from commercial banks, and here also collateral is government securities. So in this case, obviously, when RBI is borrowing, so the reverse repo rate will always be less than repo rate. Because in the case of repo rate, who is buying? Commercial banks are buying. And in the case of reverse repo rate, who's taking? RBI is taking. So reverse repo rate is always less than repo rate. And we have shared this standing deposit facility is what? Standing deposit facility is banks keeping their money with Reserve Bank of India without any collateral, but they get return is less than repo rate by how much? 25 basis points. Okay, term money is also there. We have shared call rate. Call rate is for 1 day and term money is for 14 days. So more than 14 days, if the bank need money in that case, they go for term money. So term money rate is a longer term variable rate, which nowadays RBI is offering, that is known as longer term variable rate and reverse repo rate. So this is for more than 14 days. If bank goes for more than 14 days, then the repo rate is long term variable rate. Variable rate which varies depending upon how the market is responding. It is not fixed. It varies, but it is a longer term. Longer term means more than 14 days. Net demand and time liabilities and liquidity adjustment facility. Liquidity adjustment facility is the facility which is offered by Reserve Bank of India to commercial banks through repo rate and through other instruments. That is the liquidity adjustment facility. Net demand and time liabilities. Demand and time liabilities are the checkable deposits and time deposits. These are liabilities for the banks because they have to pay interest on these. So that is why they are liabilities. How much demand deposits and time liabilities are there with respect to the bank's total assets? That is known as net demand time liabilities. That how much liabilities banks are having and how much assets the banks are having. So the difference, that is asset liability management of the banks, which they have to maintain, and liquidity adjustment facilities from the side of RBI, which ensures that how much liquidity should be there. Statutory liabilities means liabilities, Muhammad, statutory liabilities means which is obligation of banks which they have to maintain, and these liabilities they cannot escape as per the guidelines of Reserve Bank of India. So since these are statutory liabilities as per the guidelines, which is mandatory for them or which they are bound to follow, that is why this is known as statutory liabilities. Money kept aside by the banks as per the RBI guidelines, which they cannot go for the loans, that is statutory liabilities, which are bounded. Banks have to go for those kind of money which they have to keep it aside. And we have already shared, they do not keep it idle, they go for investments, statutory as per the guidelines. Okay, so reverse, you understand, reverse repo is when RBI goes for borrowing with the help of collateral. So please do remember, whether it is repo rate or reverse repo rate, collateral is there. What is that collateral? Collateral is government securities. So through government securities, with the condition that we'll buy back again on this specific date, the transaction happens. Only thing you have to remember in the case of repo rate, commercial banks are borrowing and they are keeping their government securities with Reserve Bank of India. In the other case, what's happening? Reserve Bank of India is taking and the government securities are with they keep the government securities, they give government securities to the commercial banks, but they get lower interest rates. Okay, so that's the difference between reverse and fine tuning is to maintain liquidity in the system. So statutory liquidity ratio, we have shared what is statutory liquidity ratio. Bound banks are bound to keep money aside. They do not keep it idle. They deposit in the forms of they invest in the form of gold, government securities, and others. Okay. So every bank shall maintain in India assets, the value of which shall not be less than such percentage of the total of its demand and time liabilities in India. So as CRR, they have to maintain as per demand and time liabilities. Similarly, statutory liquidity, they have to maintain as per demand and time liabilities. Open market operations where they can buy, RBI sells government bonds and securities in the market. Banks as well as others can buy and sell. So this is buying and selling of government bonds and securities is known as open market operations. When RBI will go for selling it, RBI will sell it when there is more liquidity in the market. So they go for selling it. Once they sell, you buy bonds, you buy bonds, you buy securities, banks buy securities, banks buy securities means money comes back to Reserve Bank of India, liquidity gets absorbed. Reverse will be true in the case of when they want to inject money in the system. What is marginal standing facility? Will be right in the new CS syllabus. Pranav, that I'll share it later. If you are appearing now, you will be, if there are any changes after that, then you have to go for the new syllabus. If there will be any modifications, little bit modifications if they are there, then in that case. Okay, so marginal standing facility, what is marginal standing facility? Marginal standing facility is that banks can get money from Reserve Bank of India by depending on how much statutory liquidity they have. So if they have banks, they go for keeping more statutory liquidity ratio because they do not want to go through that risk. Okay, so if they what is there in the master circulars issued by the Reserve Bank of India? Manoj, what do you want to say is master circular uh, issued by Reserve Bank of India? It is master circular. In this chapter, we are not sharing master circular. In this chapter, we are sharing monetary policy, which was declared a few days back. Yes, few days back, I believe 5th or 6th, monetary policy was declared. So we are sharing that in that context, monetary policy. Master circular covers everything of Reserve Bank of India. So we are not talking about master circular here. Okay. So marginal standing facility is where the banks, they need money. They can borrow overnight from Reserve Bank of India. In this case, it is based on yes, Pranav, we can discuss this later because this is not, if you are planning for May 2024, we can discuss this later. But let me complete this because this is important for you. You're going off the track by talking about this. There are some modifications, but it depends on those who are following this. They will be given an option to complete within a specific period of time before they go for the new scheme. So it will not be like that if you're appearing in May 2024, then you will be bound to go for other papers. So I say I will give you, Board of Studies will give you time till the time you complete your intermediate before you go for the new scheme, which they may offer very soon. Okay. So don't worry on that account. So what is marginal standing facility rate? Marginal standing facility rate basically is that the bank or the banking industry is in need of money. Overnight, we can get it from Reserve Bank of India based on how much statutory liquidity ratio I have. So the upper limit fixed is 2%. If 22% is statutory liquidity ratio, the 2% of that will be only you will be able to get funding, not more than that. So the limit is fixed up to only 2% of it you can get funding. So it is basically when there is sudden liquidity shock, which was not anticipated as such, then in that case, RBI help bankers to support them by creating liquidity through this safety wall where banks can borrow from Reserve Bank of India at 25 basis point above the policy rate. So if the policy rate is 5.25, then in that case, policy repo rate is 5.25. Then through marginal standing facility, banks can get in a dire need of liquidity shocks from Reserve Bank of India at 5.5. 25 basis point, you understand? That is 0.25. So 1 basis point is 1 by 100. So 1 by 100. So 25 basis point is 0.25. So if the repo rate is 5.25, then in that case, marginal standing facility will be 5.5. So it will be little expensive, obviously. So getting through marginal standing facility, banks can get money, can become liquid in the time of contingency, but it's quite expensive. 25 basis point over and above they have to pay. Okay, so that is about marginal standing facility. In unanticipated liquidity shocks, RBI helps. Liquidity adjustment facility is basically there are different tools through which RBI ensures liquidity in the banking system. If need arises, it can absorb liquidity. If need arises, it can inject liquidity. That is why it is known as liquidity adjustment facility. And there are different tools which are used in liquidity adjustment facility. One is standing deposit facility, marginal standing facility, open market operations, marginal stabilization scheme. So marginal stabilization scheme also we are going to share. So there are different ways through which RBI, what exactly is liquidity adjustment facility? Liquidity adjustment facility is the facility which is with RBI, through which RBI facilitates banks to maintain enough liquidity depending upon the context. If they are running short of liquidity, then RBI will inject liquidity. If they are having surplus liquidity, then RBI will absorb liquidity. How will it do it? It can do it through standing deposit facility, where banks are having enough liquidity. They can go for depositing that with Reserve Bank of India and they can get certain interest rates. Marginal standing facility, when banks are in need of liquidity, they can get money from Reserve Bank of India by paying 25 basis point above the repo rate. When they go for depositing, in the case of excess liquidity with Reserve Bank of India, then in that case, they get less than the 25 basis, less than the repo rate. So this is how RBI facilitates liquidity within the financial system through banks by opting different options. So liquidity adjustment facility is the mechanism by which RBI or the central bank manages the liquidity needs of the commercial banking system. It was introduced in 2000, and this has become a major instrument for RBI for monetary policy to support the liquidity of the banking system in the case of crisis or when they want to go for absorbing surplus liquidity. So it is easy money which is available in the immediate need of banks when they're running short of liquidity. It can also absorb the liquidity we have already shared, and this is important for banks to be more short term, very short term. It is liquidity adjustment facility. No. Please you understand, liquidity adjustment facility overnight is which case? Marginal standing facility, and it can be standing deposit facilities overnight. Liquidity adjustment facility also involves for open market operations and other options also. So liquidity adjustment facility have different tools, and in these tools, some are overnight, some are for a specific period of time. Okay, so liquidity adjustment facility has two legs. One is the repo, I've already shared. Other is reverse repo. Repo provides injections or liquidity into the banking system, and reverse repo absorbs it, because reverse repo, what happens? RBI buys, no? So that is about liquidity from the system. So banks can avail, we have shared term, long term also. Long term is more than 14 days. So Sudhanshu, more than 14 days is not overnight, no? That is also taking care about liquidity for the banks. So if it is more than 14 days, then also they can take it from Reserve Bank of India through liquidity adjustment facility. So it is for 1 day also, it can be for 14 days also, it can be more than 14 days also. So what is liquidity adjustment corridor? Corridor means what is the marginal standing facility is where banks, they go for taking money from Reserve Bank of India through based on their net demand and time liabilities based on SLR, isn't it? So based on SLR, they get it at 25 basis point over and above. So that is the upper limit. So 25 basis above repo rate is marginal standing facility. Standing deposit facility is 25 basis below repo rate. Because here what banks are doing? They're depositing their money with Reserve Bank of India because they have surplus liquidity. So they go for depositing with Reserve Bank of India. What rate they get? They get 25 basis less than the repo rate. So the upper limit is of the marginal standing facility, which is 25 basis plus repo rate. Lower limit is standing deposit facility, which is 25 basis less than the repo rate. And in between is the repo rate, which is the policy repo rate between the two. Okay, so this is, so the main liquidity management tool is 14 days. We have already shared 14 days is the long term. More than 14 days can be long term. 14 days is term. Okay, so banks can go for taking care about liquidity through this liquidity adjustment. Then the market stabilization scheme. What is market stabilization scheme? Market stabilization scheme is something where government goes for borrowing. Okay, so this scheme came into existence by, before this, can we take break for 10 minutes? Because it is already 7:45. So shall we take break for 10 minutes and then we can resume and share further? Hello. So we were talking about market stabilization scheme. See, from the very beginning, we have been sharing that Reserve Bank of India has to maintain liquidity, isn't it? So there was a MOU between um, Reserve Bank of India and Government of India to take care about sterilization. Sterilization means to maintain liquidity in the system, enough liquidity, so that the country should not suffer. That is the sterilization. Sterilization is basically to maintain, because what happens in the if foreign exchange dollar inflow increases in the country, if dollar inflow increases in the country, then in that case, what can happen? The rupee will become like rupee becomes stronger. Rupee becomes stronger, and that can be problematic for the players who are like exporting, isn't it? So the exports proceeds will decrease, and respectively the production in the country will decrease, and imports vice versa when the rupee depreciates is on the vice versa side. So to sterilize the economy from such kind of fluctuations in the economy, that's the MOU which has been signed between Government of India and Reserve Bank of India, because Reserve Bank of India is a representative of Government of India. Government of India cannot directly enter into the market, so it routes through Reserve Bank of India. That's the MOU which was signed to sterilize economy. Sterilize economy means there should not be any downfall, and there should not be uh, sudden impact on the economy. To safeguard economy from such kind of a scenario, RBI has been appointed as the body to regulate it or to monitor it, to stabilize it, and to sustain it. Okay, so that's the role of RBI. Now, keeping this into consideration, if you look at RBI book, Reserve Bank of India also maintains its books, no? So what is there in RBI books? If you look at RBI books, what is there on asset side and what is on the liability sides? Any idea about? So assets of Reserve Bank of India will be what? With the balance sheet, if you look at RBI's balance sheet, on asset side, you'll find foreign exchange reserves and government securities. If you can remember, when we were talking about money supply, we said high-powered money. High-powered money is issued by Reserve Bank of India. And what is the basis of issuing high-powered money? It is based on how much foreign exchange reserve government RBI is having, and gold RBI is having. So foreign exchange reserves and government securities are assets for Reserve Bank of India. Yes. So Forex, that is dollar, and government securities, that is zero credit risk, is government assets. Sorry, RBI's assets. And what are the liabilities of Reserve Bank of India? Liability on the liability side is having high powered money. What is high powered money? High powered money is currency with the public and reserves held in the RBI, with the banking system. So money which is there, which is not, which is with the Reserve Bank of India, of the banks, and with the public, currency with the public. You remember we had shared high powered money, C plus D, currency and deposits. That's the high powered money. So high powered money is liability for Reserve Bank of India, and asset is, on the asset side, it is Forex and government securities. Okay, Forex and government securities is on the asset side. Okay, do remember this. Now, what happens if foreign exchange reserves increases, if Forex increases, dollar increases? So that means RBI will be having more of assets, isn't it? So in that case, but RBI has to maintain a balance. So what RBI has to do? RBI has to go for increase in liabilities. So that means high-powered money should increase. So high-powered money increases means money supply in the economy will be increasing. Money supply increases means money multiplier impact will be there, because you remember we had shared money multiplier impact. So money multiplier impact will be there. This will lead to surplus money in the economy. Does RBI keep Forex in currency notes? See, balance of payment of the country. Okay, balance of payment of the country. If you know about Manoj, balance of payment, if you have seen, in which India's assets, liabilities, and plus export imports, everything is reported in balance of payment. It is maintained in two currency, dollar and INR. Any transaction which happens through banks, all accounts are settled in INR and dollar. You may be transacting in yen, you may be transacting in euro, you may be transacting in GBP, whichever currency you're transacting. But banks, when they make settlement, they always go for in dollar terms and with respect to INR, because dollar is the base currency. We'll share this when we'll talk about foreign exchange. So all records are maintained in two currency because dollar is the most acceptable currency in the world market. So we maintain our records in two currency, dollar with the banks, dollar with Reserve Bank of India is assets which are there. It can be in currency notes, it can be in any. Normally it is in the currency form only, or the other form of assets, investments which has been done is also part of Forex. So money invested in the banks, money invested with the Reserve Bank of India, bonds purchased, all those things are part of Forex. Forex, okay? So foreign exchange, RBI invested and the returns they get through Forex. So that is all. It's not always in currency. It can be in any form. Foreign exchange reserves, what we have. So rise in the foreign exchange reserves results in what? Then RBI has to intervene, because if RBI won't intervene, what's going to happen? Forex reserves have increased. So they have more assets. At the same time, they have to go for high-powered money. So money release will increase. Money multiplier impact will increase. And this will lead to more money in the market, which is not acceptable. So to take care about that, equating these two, what is required is that Reserve Bank of India will, government takes care about this. How government takes care about this? So in this case, the sterilization by RBI, because RBI has to constantly go for government securities. So RBI was losing government securities, and since RBI was losing government securities, it could have had bad adverse impact on the balance sheet of Reserve Bank of India. So that's why Government of India entered. How Government of India entered? Government of India said through this stabilization mechanism, they said that we'll go for borrowing from Reserve Bank of India. So Government of India borrowed from Reserve Bank of India, and this borrowing is over and above what government required. So government borrowed this specially so that RBI should have more treasury bills, because they were running short of treasury bills, because the balance sheet was getting affected, because the foreign exchange reserves were increasing, and to match up that they had to go for more money supply, and for money supply they were losing government securities. So since they were losing government securities, and to meet up to the expectations, or to have the benchmark level of government securities, or to have safeguard in terms of government securities to sterilize the economy, it was essential that RBI should have enough government securities. And to have enough government securities, what Government of India did? Government of India borrowed from RBI. They borrowed money from RBI, and they borrowed money, and in lieu of that, they gave them government securities. So they issued government securities. RBI got government securities, and this helped them to absorb excess liquidity from the market which was created because of the money multiplier. So liquidity got absorbed. RBI got government securities in its balance sheet. Government of India borrowed money, and this is how the system was back in position. So this sterilization scheme, what is the basic idea? It is introduced to go for absorbing liquidity. And we have shared that liquidity adjustment facility comprises of different ways. So this is also one of the ways to maintain liquidity. So other is through open market operations, otherwise through liquidity adjustment facility, and if not, then in that case through this marginal sterilization scheme. So in this marginal sterilization scheme, what's happening to bring market market stabilization scheme, which is to sterilize only. So to market stabilization scheme, what is happening? In this case, RBI is getting government securities because Government of India is borrowing from Reserve Bank of India because there is forex overflow and surplus of forex inflow, and because of that, government securities were depleting with Reserve Bank of India. So securities issued under market stabilization scheme are issued by way of auctions conducted by Reserve Bank of India and with the ceiling of mutually agreed amount of but the beauty is that this amount of money which is raised through this cannot be used for any other purpose by government, because you understand, if government borrows from Reserve Bank of India, and the idea is that to suck liquidity from the market, and if government borrows and it's going to spend, so then that means government is again injecting liquidity in the system, so the basic objective will be defeated. So that money government won't use for injecting in the market. Okay, so the basic idea is to absorb surplus liquidity from the market and bring stability in the market, which is done by Government of India borrowing from Reserve Bank of India and issuing government securities to Reserve Bank of India. And these government securities, when issued to Reserve Bank of India, Reserve Bank of India will go for auction of these government securities in the market. People will buy these government securities. Money will be absorbed from the market because people will be buying these government securities and the money gets absorbed. This is how stabilization happens, through market stabilization scheme. Okay, so this is clear, market stabilization scheme. Then this we have already shared. I had shared initially, but I'm sharing it once again. See, the core goal of monetary policy is first and the foremost to take care about inflation. Because if inflation not handled in a short span of time, it can create very high level of unemployment. It can make adverse impact on economic growth. It can hurt sentiments of people. It can lead to decrease in investment demand in the economy. It can lead to pulling out funds from the country. It can adversely affect corporate. It can affect balance sheet of banks. So it's very, very important to take care about inflation. That is the first and the foremost objective of Reserve Bank of India. And for that, they have to make a specific framework within which they have to work. And this is under Section 45ZA. The central government, in consultation with Reserve Bank of India, determined that we have to decide about that what is the rate of inflation acceptable in our country. If you see US and others, they have inflation target up to 3% max to max. In India, we have upper limit of 6% and lower limit of 2%. Why? Because India is still growing. We have the potential. We have still to capture so many untapped areas. Still there's potential to grow. So that is why we can accept, it is acceptable in a country like India, which is growing, to have max to max 6% inflation. So inflation target has been decided. And inflation, how it is measured? Inflation is measured through consumer price index. So I don't know if people have studied inflation or not, but you understand that inflation in the country is measured through consumer price index. What exactly is consumer price index? Consumer price index is the index where what we consumers we consume based on our consumption pattern, weight is assigned to each and every component, and the basket is created. This basket comprises of consumption goods and services. And in this basket, the highest weightage has been given to food products, because major expense of people is food. So they calculate the consumer price index as a measure of inflation. And on an average, the inflation should not increase beyond 6% and it should not go beyond 2%. So the limit is 2 to 6. That's the limit. So the inflation target had been decided in August 2016, and this is applicable till March 2021. 2021, it was till to March 2021, and then again they have revised it from April 2021 to March 2026. So March 2026, the 5-year period inflation rate is target has been fixed between 2 to 6. So who has to ensure that the inflation should not go beyond 6%, should not go beyond? So they have made a monetary policy committee. This monetary policy committee comprises of 6 members. These 6 members, 3 of them are from Reserve Bank of India, and 3 are appointed by notification of Official Gazette of Government of India. So they may be from academia, from IIMs, or maybe from Niti Aayog, or from somewhere or other. Okay, so 3 people are appointed by Government of India, and 3 people are from Reserve Bank of India. And the chairman of this monetary policy committee is Governor of Reserve Bank of India. So Shaktikant Das is the Governor of Reserve Bank of India. He is the chairperson of MPC, and we have 3 people from, including him, 3 people from Reserve Bank of India and 3 from appointed by Government of India. Okay, so these 6 members work on different parameters in a way that inflation, and try to ensure that inflation should not go beyond 6%. Whatever may be the circumstances, today you see oil prices are going up, and OPEC countries have said further that we'll control the oil supply and will, so the prices are further going to shoot up. There are many other factors which may lead to high price level, but it is the duty of Reserve Bank of India Monetary Policy Committee to ensure that as far as possible that prices should not go beyond 6%. So these 6 members, they work. So the first Monetary Policy Committee was constituted on September 29th, 2016. Okay. And the Monetary Policy Committee is responsible, I've already told you, for fixing the benchmark interest rate. So they decide about that what should be the repo rate, which repo rate we should decide, because you see all rates are based on repo rate. We have seen liquidity adjustment facility corridor. So the standing deposit facility is lower than the repo rate, and the marginal standing facility is above the repo rate. And all rates in the market, we have seen the interest rate channel monetary policy transmission also. So this repo rate to be decided is the most important parameter of Monetary Policy Committee. This is also known as policy rate. What should be the policy rate we should decide, so that liquidity, credit, inflation, economic growth, stability, expectations of people, and output of the country should grow. So that is what monetary policy job is, Monetary Policy Committee job is. Okay. So this committee, I've already told you, 3 people external and 3 internal. And before they go for announcing monetary policy, 7 days pre and post, they are not supposed to share anything, because you understand, if you have seen market, when the monetary policy is announced, or when it is going to be announced, prior to that and immediately after that, you see whole lot of changes in the Sensex, and newspapers and everywhere it is like the news is flashed with this only, that monetary policy report has been declared, and this is the rate which has been, that is unchanged, this is changed, and so on. So when the monetary policy was announced, after that, Economic Times 3 pages were full of monetary policy report. What I mean to say, that why is this so important, monetary policy? Why the repo rate is so significant? We have shared different channels through which monetary policy transmission happens. So it makes impact on each and every player. It makes impact on Sensex, it makes impact on consumers' wealth, consumers' income, it makes impact on companies' balance sheet, it makes impact on banks' financial health, it makes impact on government debt. It makes impact on foreign exchange. So it makes impact on real estate. It makes like it affects every corner, every stakeholder in the economy. And that's why it is very important that they should not disclose things in such a manner which may create uh, rumors in the market, and some people by manipulating the market can gain through this. So that is why it is very, very important to keep utmost confidentiality and remain quiet or silent, and do not disclose anything that the rate will increase or not. Let people keep on guessing. The day monetary policy will be announced, then only people will come to know, has it gone up, has it gone down, and it is made on the consensus. So they go for voting. They vote by saying that how many members are in favor of increasing interest rate, how many members are against it. And if majority of them say yes, then they go for increasing the interest rate. If majority of them say no, then they won't go for increasing interest rate. So this is the beauty of Monetary Policy Committee, because 6 members are working, and these 6 members are from diverse field. 3 are appointed by government and 3 are from Reserve Bank of India. So Reserve Bank of India core objective is inflation to be controlled. But these 3 people may think about that economic health is important, growth is important, um, sentiments are important, other factors are important. So that is how they settle in between somewhere sometimes. And people keep on guessing that will the rate go up, will the rate go down? And that's why the market keeps on fluctuating based on the anticipation. Okay, so that is Monetary Policy Committee. So Monetary Policy Committee determines the policy repo rate to achieve or to retain the inflation target, keeping all challenges into consideration, how the market is behaving, how international world is behaving, what's happening in other countries, its impact on India, what Fed rate is decided about, and so many other factors. How foreign banks are performing. There's so many factors which make impact. So that's a very complex decision to decide about, shall we go for increasing the repo rate or not to go for increasing the repo rate. So Monetary Policy Committee is required to meet at least 4 times in a year, and this quorum has to have 4 members at least, and each member has to go for giving 1 vote. They have a right to give 1 vote, and the votes are equal. And governor has a second or a casting vote. So final vote is of governor, because governor is the chairperson, and then they go for deciding about, and then they make the statement that are they in favor of policy rate increase or not, and what makes them to decide about increasing or not. So this is how they go for. So Monetary Policy Committee, if you people are reading newspaper, you might have read that on 6th April had gone for assessing. So 3rd, 5th, and 6th April, they had assessed the macroeconomic situation, how macroeconomic conditions are in India, how the world is performing, what impact it is going to make on India, how corporates are doing, how consumers are behaving in terms of their spending pattern, how banks' health are. All these factors taken together, they decided that we are not going to change the repo rate despite inflation is increasing. So repo rate they didn't change the repo rate. Repo rate is 6.5. So repo rate they kept 6.5. Then standing deposit facility we have shared that it is 25 basis less than the repo rate. So you see standing deposit facility rate remained unchanged at 6.25. Since the repo rate is 6.5, so the standing deposit facility remained 6.25. What is standing deposit facility? It is about surplus money with the banks, which they go for depositing with Reserve Bank of India, and they get return of 25 basis points less than the repo rate. So 6.25 is the standing deposit facility, and the upper limit is marginal standing facility, that is 25 basis point above the repo rate. So this is the liquidity adjustment corridor you see here. So the lower limit is 6.25, that is standing deposit facility. Upper limit is marginal standing facility, that is 6.75, and the repo rate is 6.5. What is marginal standing facility? Marginal standing facility is banks, they need a funds, they go to borrow from Reserve Bank of India by through statutory liquidity ratio, and they go for 2% of the SLR they can go for getting this. So this is liquidity adjustment corridor also we have shared. So MPC, that is Monetary Policy Committee, also decides by majority. I've already told you, majority of the people have to give vote for one thing. That should we go for accommodative monetary policy? I've already told you what is accommodative monetary policy, and unconventional monetary policy. So accommodative monetary policy is that inflation is increasing. I'm sorry. Our target is also to control inflation, but at the same time, economic growth should not hamper. Sentiments of people should not be so low that these people stop investing in the market or corporates stop investing in the market. So that is why it's important to support growth. So if we cannot go for taking we do not want to affect growth, then in that case, despite inflation on the higher side than 6%, still we will go for keeping the repo rate, maintaining the status quo of repo rate. So that is what was decided about by the team of Monetary Policy Committee. The Monetary Policy Committee, which was had presented their report on 6th of April 2023. Okay, so what Shaktikant Das has said, that to recapitulate the actions taken so far, I've taken it from Monetary Policy Report. We have increased the policy repo rate cumulatively by 250 basis points in the last 11 months. So what RBI did from May 2022 to April 2023, they have increased the repo rate by how much basis point over the period of 250 basis point. And we have shared basis point is 1 by 100. So that is they have increased by 2.50 basis point over the period of 11 months. And why they had to increase? Because inflation was increasing. So that is why they had to increase the repo rate. Okay, this was preceded by the introduction of the standing deposit facility at the rate 40 basis higher than the fixed rate reverse repo rate. So they had increased the standing deposit facility by 40 basis point, had gone by 40 basis point, and the effective rate since April last year has been 290 basis point. So 250 plus 40 is 290 basis point. So the overall rate increase was 290 basis point over the last 11 months because of the increasing inflation rate. These increases have been fully transmitted. So we have shared transmission, monetary policy transmission. And what was the impact of this? Have been fully transmitted to the overnight weighted average call money rate. The operating target of monetary policy had gone up from 3.32% in March 2022 to 6.52% in March 2023. So credit became expensive, and you can see here it went up to what? 6.52 in March 2023 as compared to 3.32 in March 2022. So as the money demand increased, as the inflation increased, one front, the repo rate increased. At the same time, the call money rate also increased. And that is why this time they didn't go for increasing further the repo rate, because if they would have had further increase, growth would have been adversely affected to great extent. And to maintain the status quo of the growth, it was important, and to maintain positive sentiments of people and corporate, and to take care about financial health of companies, it was essential to maintain the status quo. That is what was decided by the Monetary Policy Committee members in the meeting. Okay. So this is the core of monetary. So what Shaktikant Das is saying, when we started the rate cut cycle in Feb 2019 to provide support, 2019 was COVID time. So they had gone for rate cut. So their policy rate was low, and inflation was also around 2%. Can you imagine? Inflation was 2% and the policy repo rate was 6.5%. So inflation was 2% and policy rate was 6.5%. So they decided to, now today you see, policy rate is 6.5% and inflation is 6.4% in Feb 2023. So overall inflation has gone up because we have said inflation should not go beyond 6%, but it is now 6.5%, 6.4%, sorry, 6.4%, which is higher than the target limit. But still they have gone for accommodative monetary policy. Accommodative monetary policy is that means to take care about accommodating economy, economics, accommodating the policy rate to boost economy and not to make countries suffer because of the inflation and the negative impact. So that is what is about this monetary policy. Any questions if you have, I can take. So you can read monetary policy report from RBI, which was introduced, and try to connect concepts which we have shared over here with respect to monetary policy. And you can always quote in your exam, you will get better marks, because if you'll talk about the current scenario, obviously it matters. Any questions if you have, I can take it. Any doubts? Any questions? I'm waiting for you people if you want to share. So what we have shared, just to recap fast, since you are not asking anything. Okay, just to recap. So monetary policy, what is the significance of monetary policy? It is monetary policy is the lifeline for the country, because it helps to decide about that how the policy rates to be decided. These policy rates have a transmission effect. Transmission effect is not only on banks or the financial of the country, it is also on companies, it is on households, it is on foreign exchange, it is on capital market, it is on real market. So Bhumika is asking, what is the meaning of constant behavior of public and commercial banks? See, Bhumika, we had shared that how commercial banks behave. Commercial banks' behavior is based on what? Interest rates. When commercial banks think that, and constant behavior of commercial banks and uh, public is, if you talk about inflation rate, okay, inflation target. If inflation target is maintained, so what will happen? People will get confidence. Public will get confidence. If public will get confidence, then in that case, you will not go for changing your behavior in terms of credit, in terms of deposits. Because what happens when you are uncertain about inflation, how your behavior changes? You believe that tomorrow inflation will increase, let me buy more. When you believe that inflation will decrease, you're not certain about inflation, then your behavior is random. And your behavior is random because you do not have confidence in monetary policy and the inflation rate. You are not sure about inflation rate. So you may go for hoarding, you may go for refraining from buying. That is how consumers they behave when they are uncertain about the inflation rate. What about commercial banks? Commercial banks decides about, we have shared commercial bank decides about the interest rates. And these interest rates decides about corporate buying behavior and public buying behavior. So when commercial banks will be ensured that inflation is not going to increase or inflation is going to remain within the limit, then in that case, commercial banks know that if we lend to people, whether you are a consumer or whether you are a corporate, then the chances of you defaulting or not paying back to the bank is very rare. So bank also becomes confident about that we can lend. So credit channels become more streamlined. Corporate, they borrow more streamlined manner. Consumers, they become more confident. This helps investors become more confident, and this is how it helps. So that's the benefit of inflation targeting. If inflation is within the range, people behavior becomes more constant or predictable, and commercial banks behavior also becomes more predictable because they are more confident about the economy. Their lending pattern becomes more consistent. That's the impact of behavior, constant behavior, and in terms of inflation targeting. Is it clear? Bhumika, anyone else? Any question? Manoj, what is the fundamental difference in US and Indian economy? Oh God. See, Manoj, what is about Indian economy? One, demographics. we have the youngest population in India. Number two, we have still potential to grow. Number three, India is having uh, India is having growth potential. India is having manufacturing base. India has the potential to enhance its logistic growth and contribute to the world market. But US is at a saturation point. US has reached to the fourth industrial revolution. They are fully developed. They have capital, but at the same time, there is inflation is increasing in that country. Why? Because of Russia and Ukraine crisis. And this country is becoming more import driven. That is why they're imposing sanctions. India is becoming more open economy by promoting exports because we have more potential today. So number three, that Indian economy, US economy, dollar is the currency which is traded all across the world. And China is having more dollars, you know this, as compared to US. So that is the factor. Apart from that, US is more becoming at the. If you have studied product life cycle, if you have studied the country's growth, if you you know the catch, the pace at which you can catch up with the country. So India is still to grow. India has the potential to grow. India has the demographics to grow. But US is at a saturation. So definitely India is at edge as compared. And number three, that India's financial system is more strong. You know about Silicon Valley Bank and others collapsed. So India's financial system is very strong. India's RBI is more conservative. So India is more in safe hands as compared to US. Okay then. India is mixed. Bhumika, India is moving towards more of capitalist economy over the years. You see the way we are going for privatization. There's still scope, huge scope for India to yet become completely capitalist economy. So that's it for the day. Take care and keep reading. Okay, then.